Hey everyone, welcome to the vignette on shareholders' equity. From the balance sheet equation, you are already familiar with shareholders' equity. Numerically, the dollar amount on the balance sheet you observe for the line item total shareholders' equity simply captures the difference between total assets and total liabilities. However, this line item can have various synonyms in balance sheets, including just stockholders' equity, or owner's equity, or simply equity alone. Within the total shareholders' equity section of the balance sheet, there are multiple accounts that can appear. Conceptually, we can classify all equity accounts into two broad categories. The first category pertains to common equity. These are ownership interests of the holders of the firm's common stock. Common stockholders are the residual claimants of the firm. The second category pertains to financing sources beyond common equity, which we will refer to as non-common equity related. Let's start with accounts that appear in the common equity category. The first one you'll see is called common stock, or sometimes called common stock par account. The dollar amount you observe in this account is the shares times the stated par value. The par value is a legal nominal value that's assigned to each share. Do not confuse par value here with a bond being issued at par. Also, firms on rare occasions can have more than one type of common shares, and if they do, each is listed separately. The next account you will see is additional paid-in capital, or sometimes just referred to as APIC. This is the difference between the dollar amount a share sold for and the par value for the same common share. Synonyms for APIC include capital contributed in excess of par or capital in excess of par value. So conceptually, every dollar raised when a firm issues common shares is split between the account common stock, based on the par value, and APIC, which is the amount paid for the stock over and above the par value. Sometimes a firm will collapse common stock and APIC together on the face of the balance sheet, so you'll have to read the footnotes to break the total down further. The next account you may see is called treasury shares. Treasury shares are common shares bought back by the firm but not retired because the firm has the intent to reissue them. This is a contra equity account, which means it will carry a negative balance in the owner's equity section. This concept is just like the contra asset account allowance for doubtful accounts, which is a negative value on the asset side of the balance sheet. The dollar amount you will see for treasury shares is equal to the number of shares repurchased by a firm times the purchase price paid by the firm to buy back the share. The next account is retained earnings. Retained earnings is the accumulation of all earnings that the firm has not paid out in dividends. If the accumulation of all net income less dividends is a negative number, this account is instead referred to as accumulated deficit. The next account is accumulated other comprehensive income, or sometimes referred to as AOCI. This is the accumulation of earnings that bypass the income statement. Many types of earnings that bypass the income statement we will not cover in this introductory course. Now let's turn to non-common equity accounts. The first one you may see is called non-controlling interest. It also goes by the name minority interest. This is the portion of another firm that the firm has control over but does not technically own. This happens when a firm owns more than 50% of another company, but not quite 100%. The final non-common equity account pertains to preferred stock. These are shares issued that are not common shares, but have features that behave more like bonds than common stock. Let's run through some examples to show you how the accounting system would capture transactions pertaining to the common equity and non-common equity accounts we have just introduced. We will conclude by looking at all these accounts at the company PepsiCo, who makes Pepsi Cola and Doritos. Let's start with the issuance of common shares by the firm to raise capital. This will illustrate the use of two accounts in the common equity category called common stock and additional paid-in capital. Suppose the firm raises capital by issuing 10,000 shares of 5-cent par value common stock. And suppose those common shares are sold to the market at $22 per share. How would the accounting system record this? Using the balance sheet equation, we can think through this. Clearly, the firm receives cash of $220,000, which is 10,000 shares times the $22 per share investors paid. So assets go up by $220,000. And of course, that would appear in the cash account. There are no liabilities from this transaction since the firm doesn't owe anyone anything, which must mean that shareholders' equity has gone up by $220,000 in total. The accounting rules dictate that this total be split into two separate accounts. The first is the account common stock, which would increase by $500. The $500 equals the par value of 5 cents per share times the 10,000 shares issued. The remainder is plugged to the APIC account for $219,500, as this represents the additional amount paid by investors over and above the par value. Note that after issuance, 10,000 common shares are considered issued and outstanding. That means the firm sold them and they are out in the marketplace. Now suppose after issuance, the firm wants to buy back some shares it issued previously with the intent of reissuing those same shares later in the future. Firms will do this many times when they pay employees in stock. When a firm does this, they will use an account called treasury stock. Treasury stock is a contra equity account. And you saw a contra asset account before in the form of allowance for doubtful accounts, which was a negative number offsetting the asset accounts receivable. The same idea happens here in equity. Putting numbers on this, suppose the firm buys back 1,000 shares of the 10,000 that it previously issued. Assume additionally that the firm pays $18 per share to buy them back. The balance sheet equation could be represented like this, and I now include contra assets and contra equity just to illustrate. What you see here is that clearly the firm is going to have to pay $18,000. So $18,000 in cash is going to go away and assets are going to go down by $18,000. Again, there is no liability. So to balance the balance sheet equation, we use the treasury account, which, because it is a contra account, has a negative impact on equity by the same $18,000. Note three things. First, the total shareholders' equity account balance is now $202,000, which equals the $220,000 from the initial issuance on the prior slide, less the $18,000 from the buyback here. Second, despite the firm issuing the shares for $20 each and buying back at a lower price of $18, there is no gain recorded in the income statement. Third, after repurchase, 10,000 shares are considered issued, but only now 9,000 are outstanding. This is because the firm repurchased 1,000 shares and they are not outstanding in the marketplace anymore. Now let's talk about the firm reissuing some of those shares that were just repurchased. The firm is reselling the shares back to the market. So suppose the firm reissues 600 shares of the 1,000 shares they had previously repurchased for $18 a share, but sells them back to the market at $25 a share. Clearly, there is an economic profit here per share equal to the difference between $25 and $18, which is $7. The firm sold 600 shares, so 600 times $7 would seem intuitively like the firm has generated a $4,200 profit. But this cannot go in the income statement because the profit has arisen from the firm trading in its own shares. To record this in the accounting system, we start with the balance sheet equation, and obviously the firm is going to receive cash in the amount of 600 shares times $25, which is $15,000. So the balance sheet equation would appear like this. Obviously, assets go up for cash, $15,000. There are no liabilities, so the balance sheet equation would imply that equity must also increase by $15,000. But in which accounts? First, the contra equity account of treasury stock goes down by $10,800, which is derived by $18 per share times 600 shares. The contra asset account going down means the negative number in equity is going away, which makes the equity balance itself go up. The remaining amount goes to APIC in the amount of $4,200. Note three things here. First, the dollar amounts are leaving the treasury account the same way they went in at $18 per share. Number two, the dollar amount plugged to APIC is capturing that economic profit of the sale of stock. Three, after reissuance, the number of shares outstanding in the market has increased by 600 back up to 9,600, because that's how many shares are now in the marketplace. Next, we have the situation where suppose a firm didn't want to use the treasury method. That means when they buy back shares from the market, they remove their existence, as opposed to putting them in a treasury stock account for reissuance later. So let's go back to the original situation where the firm issued 10,000 shares at $22 each. Now the firm is going to buy back 100 shares at $20 each, but retire the shares that they bought back. At $20 a share, buying back stock is clearly going to make the cash balance go down. And so from a balance sheet equation standpoint, assets would decrease by $2,000 for cash, and there are no liabilities, and so equity must also decrease by $2,000. But in which accounts? Common stock and APIC decrease by reversing what was recorded at issuance. The remaining amount goes to retained earnings. As note 1 shows, 100 shares at par value of 5 cents is going to reduce the common stock account by $5 because there was 100 shares. APIC is reduced by the amount over par at issuance, which is $22 per share less 5 cents par value times 100 shares. So common stock and APIC are reduced by the same amounts per share they increased at original issuance. Note 2 mentions that buying back stock for $20 per share when you sold it initially at $22 a share seems like an economic gain. The accounting system here puts this $2 gain for 100 shares, or $200, into retained earnings. Don't worry about why it is the case that you saw economic gain for repurchases with treasury method go to APIC, but now with a retirement it goes to retained earnings. They're both equity accounts. Note 3 shows that after retirement, 9,900 shares are both issued and outstanding because retirement means the shares no longer exist. So far, you've learned that retained earnings can be impacted by both share repurchases when a retirement occurs, and you already know that current period earnings obviously impacts retained earnings each year. Dividends are a third way that retained earnings can be impacted. To see this, suppose a firm declares a dividend of 35 cents per share on 2,000 outstanding shares as of January 8th, 2018. The dividend payment will go to holders of record as of January 20th, 2018, with the payment finally being made eventually on February 8th, 2018. On the date of declaration, there is a liability called dividends payable equal to $7,000. That's a liability going up because the firm is now bound to pay the dividend. That simultaneously makes retained earnings go down. Stating the date of record is irrelevant from an accounting standpoint. That just tells the firm who is going to receive the money. That has nothing to do with the overall obligation to pay. At the payment date, however, which is February 8th, cash is going to go down by $7,000, and the dividends payable account is also going to go down by $7,000. Note that this dividend payment is not an expense going through the income statement to impact retained earnings. It just impacts retained earnings directly at the date of declaration. The last common equity account is called Accumulated Other Comprehensive Income, or AOCI for short. Certain transactions are captured outside of the income statement in the account called Other Comprehensive Income, which accumulates into the AOCI account. The types of transactions that accumulate in AOCI are typically highly volatile fair value changes pertaining to things like investments, pensions, derivatives, and foreign currency issues. We will only touch on AFS securities in this course. You need to take Accounting 592, Detecting Earnings Management, to get into those other issues. The effects on the balance sheet equation can be a combination of assets increasing or decreasing and liabilities increasing or decreasing, with the overall net effect each period residing in OCI and each year accumulating into AOCI. Just like net income closes to retained earnings. Now let's talk about equity accounts that are not common equity related. The first is non-controlling interest. When a firm owns more than 50% of another company, they control it. When companies are controlled, 100% of the balance sheet of the controlled company is added to the owner's balance sheet. If the firm owns 100%, there is no such thing as a non-controlling interest. But if the firm owns less than 100%, it does not own a portion of the company. To illustrate, suppose a firm owns 90% of another company. 100% of the assets and liabilities, and of course equity, is added to the firm's balance sheet. The 10% that is not owned is then subtracted inside of the equity account in an account called non-controlling interest, or sometimes minority interest. You don't need to worry about the mechanics of recording it. You just need to know what it means when you see it. The last non-common equity account is preferred shares. Unlike common shares, preferred shares have no voting rights. Any dividends paid on these shares are senior to common share dividends, which means preferred shareholders get their dividends first. Finally, preferred shareholders get paid before common shareholders in a liquidation of the firm at their par value. Firms can issue and repurchase preferred shares just like common shares. Again, you don't need to worry about the mechanics of recording preferred shares. You just need to know what it means when you see it in financial statements. So let's take a look at a shareholder's equity statement of a real firm to put all these issues together. Let's look at the equity section of PepsiCo's fiscal year 2017 balance sheet. Total equity is $10.981 billion. Let's start with the non-common equity accounts first. You can see PepsiCo has non-controlling interest of $92 million, which captures the portion of controlled entities' equity that PepsiCo does not own. At the top of the table, you see another non-common equity account pertaining to preferred stock. PepsiCo at some point issued preferred stock equal to $41 million and has also engaged in buying back those preferred shares. They are not retiring the shares when they buy them back, as you can infer by observing the line item repurchase preferred shares, which equals $197 million. Plus, that number is negative, which implies a contra equity account. Clearly then, PepsiCo is using the treasury method even though they do not label the account treasury preferred stock. Additionally, it is clear that PepsiCo bought back preferred shares for more than they received at issuance. Turning to the common equity accounts, common equity totals $11.045 billion and is comprised of 5 accounts. Common stock at $24 million, APIC at $3.996 billion, retained earnings of $52.839 billion, AOCI, which is a deficit of $13.057 billion, and finally treasury stock of $32.757 billion. Notice again, they do not say treasury stock, but rather just list repurchase shares, and you see a negative number in equity because this is a contra equity account. That's all for shareholders' equity.